Good evening. Ian Cooper here with a look back at the week that was and what's ahead. Last week, markets fell apart again, becoming volatile yet again. The US dollar strengthened and gold and silver plummeted after President Trump named Kevin Warsh the next Federal Reserve chief. In fact, on Friday alone, the Dow Jones fell 179 points. The S&P 500 was down 30. The Nasdaq fell 223 points. Gold fell to less than 4,900, but is starting to bounce back very slowly, as you can see here tonight. Silver also fell apart. It fell under 80 the other day, but it is also starting to rebound higher again now. The Federal Reserve held interest rates steady as expected last week after 3 consecutive rate cuts at the end of 2025. The pace of easing is likely to slow as policymakers look for confirmation that inflation continues to cool off. We also had Microsoft, which was trading sharply lower thanks to concerns with CapEx spending and slower cloud computing growth. Now, the pullback in Microsoft may be a buy opportunity. However, we are waiting for confirmation of trend change before buying any call options here. Right now, Microsoft is a falling knife, so we don't want to just throw money at it and hope for the best. We want to wait for confirmation. It is also oversold on RSI, on MACD, Williams percentage range, and full stochastics as well. So stay tuned for a potential trade on Microsoft. There may also be a put option opportunity on Meta Platforms. Meta Platforms exploded significantly higher on earnings last week as well. But as you can see here, it is starting to pivot lower after gapping higher on those earnings. Now, for the week ahead, there are fears of a continued government shutdown again. Also in the week ahead, we have more big tech earnings from Amazon, Advanced Micro Devices, and Alphabet. There's also the big jobs report on Friday. We're also going to see data, including the latest job openings and labor turnover survey, as well as the ADP employment survey, all of which will give investors a better idea about what's happening with the labor market. With earnings, Amazon will release earnings on February 5th. And if the numbers are as good as they were back in October when they beat on the top and bottom lines, the stock could explode even higher. For the week ahead, Amazon is expected to post EPS of $1.97 a share for the fourth quarter, which would be about 6% growth year over year. For full fiscal year 2025, the company is expected to post EPS of $7.17, up about 30% year over year from $5.53 year over year. And for full fiscal year 2026, Wall Street is looking for EPS of between $7.87 and $7.91, or 10% year over year growth. We also have to remember that when it comes to Amazon, they are always conservative historically with their numbers, so they could be even better than what's expected there. Wedbush analysts also reiterated an outperform rating with a price target of $3.40 a share. They are expecting a big year for AWS. They also named Amazon as their top e-commerce pick for the year. They also forecast fourth quarter income of $25.2 billion with a margin of 11.8%. In the third quarter, they are also forecasting for Amazon's operating income to be about $17.4 billion. We also have earnings on deck for Advanced Micro Devices, symbol AMD. They'll post fourth quarter earnings after the bell on Tuesday. Analysts expect the company to post EPS of $1.32 a share, which would be about 21.1% year-over-year growth. Revenues are expected to come in at around 9.67 billion, which would be 26.2% year-over-year growth. In its last earnings report, the company beat estimates with EPS of 120 on sales of $9.2 billion. The company also has a very strong track record of beating EPS and revenue expectations. And we have earnings coming up from Alphabet, symbol GOOG. Alphabet will post fourth quarter and full year 2025 earnings on Wednesday after the market close as well. Analysts are looking for EPS of about 258 to 259, or about 20% year-over-year growth. For the full fiscal year 2025, analysts expect for Alphabet's diluted EPS to grow by 31.6% annually to 1058. Also, after a very strong year, 2026 could be just as strong for Alphabet, especially after Apple entered into a multi-year partnership with Alphabet to use its Gemini models and cloud technology for Apple's AI products, including Siri. Also, analysts at Raymond James just upgraded Alphabet to a strong buy rating with a price target of $400 a share. Raymond James is making the argument that Google's AI stack is shifting to high gear, possibly driving material upward revisions to medium-term estimates, according to Raymond James. There are also a lot of eyes on Bitcoin over the next few days. Should Bitcoin continue to fall as aggressively as it has been, we could look to buy put options on Strategy, symbol MSTR, as well as Bitcoin mining stocks such as Riot and MARA. So stay tuned for potential put option entries into those three stocks as well. Right now, we're just watching to see what's going to happen next with Bitcoin. What we know right now is Bitcoin is having a terrible, terrible start to the year, retreating sharply after its run to record highs late last year. Bitcoin is now trading below 77,610, and some market participants warn the sell-off may not be overdone. Some bearish forecasts see Bitcoin falling below 60,000, with extreme downside scenarios pointing to levels near 30,000. Again, should that happen, you'll see stocks like Strategy, MARA, and RIOT plummet even lower, setting us up for opportunities to buy put options in each one of those. So again, please stay tuned for more on that. So there's really a lot to pay attention to this week with earnings, with jobs reports, with the government shutdown, all of which could create even more volatility and downside for the markets, which we're paying very, very close attention to. Across our paid programs, we didn't have a whole lot of new or closed trades because of the market volatility. However, we are looking to put out many new trades over the next few days. Again, markets have been a bit crazed. Trading has been a bit bumpy with a lot of red candlesticks popping up over the last few days, pointing to further downside. You know, for us, we would rather wait on the sidelines than risk losing money by rushing trades out the door. We don't want to have to sit and guess, you know, are markets going to shoot higher tomorrow? Are they going to drop again? We'd rather not guess. We'd rather pay close attention to the fundamentals and the technicals that will drive it either higher or lower. You know, we'd rather be safe than sorry. But again, please know we are working on many, many new opportunities for you. With that, take good care. We will speak again very soon. Thanks so much. And if you have any questions or comments, please feel free to reach out at any time. I'm always more than happy to help. Take good care, and thanks.